For most of human history, money was something you could touch. You could weigh it, you could melt it, you could hide it in the ground for 50 years and it would still be money when you dug it back up. Then, quietly without a single global vote, money stopped being real. Today, every major currency on Earth is backed by nothing but debt. Not gold, not silver, not land, not even productivity, just promises layered on top of promises. Here's the mystery. If money used to represent something tangible, who decided it didn't need to anymore? And more importantly, who benefited when debt replaced gold? Because when you follow the timeline, this wasn't an accident. It was a gradual takeover executed through crises, wars, emergencies, and temporary solutions that never ended. This is the story of how gold was pushed aside, how debt took its place, and how the modern global money system was quietly captured without firing a single shot. To understand the takeover, we need to rewind to a time when money was not an abstract idea but a physical constraint. For thousands of years, gold and silver weren't chosen because they were shiny. They were chosen because they had limits. Gold couldn't be printed. Silver couldn't be fabricated overnight. Mining was slow, dangerous, and expensive. That scarcity imposed discipline. Kings couldn't wage endless wars without first securing resources. Governments couldn't promise unlimited programs without raising taxes visibly. And banks couldn't lend money they didn't physically possess. Money acted like gravity, it kept power grounded. But that discipline was also a problem, because gold-backed money made one thing extremely difficult: debt expansion. And debt, when controlled, can be incredibly profitable. The first cracks didn't come from banks. They came from states under pressure. Wars are expensive. Empires don't like limits. During wartime, governments repeatedly faced the same dilemma. They needed more money than gold reserves allowed, so they turned to a workaround. Instead of giving people gold coins, governments issued paper claims promises that could supposedly be redeemed for gold later. At first, this was honest. One paper note equals a fixed amount of gold. But temptation crept in. What if not everyone redeemed their gold at the same time? What if the state printed slightly more paper than gold it actually held? Thus began fractional reserve banking, a system built on a simple assumption: trust would prevent collapse. And for a while it worked. Banks quickly realized something revolutionary. If only a fraction of depositors asked for gold at any given moment, banks could lend the rest. Money was no longer just stored, it was multiplied. A single gold deposit could support multiple loans. Each loan created new money on paper. Debt became productive. But here's the twist. This new money wasn't created by governments. It was created by private banking systems. And governments constantly short on funds found this extremely convenient. Instead of taxing citizens directly, states could now borrow. Instead of facing political backlash, they could defer pain into the future. Debt solved everything, at least temporarily. As banking systems grew more complex, crises became inevitable. Too much paper, not enough gold. Bank runs followed predictable cycles. To stabilize the system, governments introduced a new institution: central banks. Their mission sounded noble: act as lender of last resort, stabilize currencies, prevent bank failures. But behind the scenes, something profound changed. Central banks centralized power over money creation. They became the bridge between government debt and private banking. And once central banks existed, the gold constraint became inconvenient. Gold wasn't removed overnight. It was weakened gradually. During crises, especially wars, governments suspended gold convertibility temporarily. Citizens were told, this is just until stability returns. This is for national security. This is for your protection. But temporary measures have a habit of becoming permanent. By the early 20th century, the world was running on a hybrid system. Gold existed, but most transactions were debt-based paper claims. The system was fragile but immensely powerful. And then came the moment that changed everything. World War I shattered the illusion. Governments printed money at unprecedented levels to finance war efforts. Gold reserves evaporated. Debts exploded. Currencies collapsed. After the war, attempts were made to return to gold. But the debt was too large. Gold couldn't support the promises already made. This is the moment when the truth became unavoidable. You can either honor gold or honor debt, but not both. And governments chose debt. The final break wouldn't happen yet, but the direction was set. From this point forward, gold was no longer the master of money. It was an inconvenience to be managed. Debt, on the other hand, offered infinite flexibility. It allowed governments to grow without limits, banks to expand balance sheets endlessly, economies to be stimulated without real savings, and most importantly, it allowed consequences to be delayed. But delayed doesn't mean erased, it only means transferred. The moment gold officially lost, no headlines, no alarm. The quiet takeover didn't happen with a collapse, it happened with an announcement. In 1971, US President Richard Nixon stepped in front of cameras and delivered what sounded like a technical adjustment. The United States would temporarily suspend the dollar's convertibility into gold. No emergency sirens, no public vote, no countdown clock, just a sentence. That sentence ended the Bretton Woods system, the last global framework tying money to gold. From that moment forward, every major currency became fiat, money backed by government decree and debt, not physical reserves. Gold was officially out, debt was officially in. But to understand why this mattered so deeply, we need to look at what Bretton Woods actually was and why it collapsed under its own weight. After World War II, the world was financially exhausted. Europe was in ruins. Currencies were unstable. Trade was fractured. The solution was Bretton Woods. The deal was simple on paper. The US dollar would be backed by gold, other currencies would be backed by the dollar. The dollar became the global reserve currency. It sounded like stability. But embedded in this system was a fatal flaw. The United States had to do two contradictory things at once. 1. Supply enough dollars to fuel global trade. 2. Maintain enough gold to back those dollars. As global trade expanded, more dollars were required, but gold supply didn't expand at the same pace. This created a slow, invisible imbalance. Foreign governments began holding massive dollar reserves claims on US gold that couldn't all be honored simultaneously. The system relied on one thing only: trust that no one would ask for the gold. By the late 1960s, cracks were impossible to hide. The US was funding the Vietnam War, expanding welfare programs, Cold War, military dominance, all through detritus. Dollars flooded the world. France, among others, started demanding gold in exchange for dollars. The math no longer worked. There wasn't enough gold. At that moment, the system faced its true test. Return to discipline and accept painful contraction, or remove the constraint entirely. Nixon chose removal. And once gold was gone, something unprecedented happened. Money became limitless. Without gold, money creation no longer required physical backing. Central banks could now create reserves, digitally support unlimited government borrowing, expand balance sheets without constraint. Debt stopped being a temporary tool. It became the foundation. Governments no longer needed to save before spending. They could borrow first and worry later. Banks no longer needed deposits to lend. Loans created deposits. The system flipped. Instead of money enabling debt, debt created money, and growth followed. For a while, the post-gold era felt like progress. Credit expanded, assets rose, consumption surged, homes became larger, stock markets climbed, governments promised more, but beneath the surface, a pattern was forming. Each decade required more debt than the last, lower interest rates than before, larger interventions to prevent collapse. The system became addicted. Growth was no longer organic, it was engineered. And like all engineered growth, it came with side effects. Look at the timeline after 1971. Financial crises stop being rare events and start becoming recurring features. 1970s inflation shock, 1987 market crash, 1997 Asian financial crisis, 2000 dot-com bubble, 2008 global financial collapse, 2020 emergency monetary expansion. Each crisis followed the same script. 1. Debt expands too far. 2. Asset bubbles form. 3. System destabilizes. 4. Central banks intervene. 5. Debt grows even larger. The solution always deepened the problem. Because once debt replaces gold, there is no natural stop. Every attempt to fix the system avoids the root cause. Instead of reducing debt, policymakers lower interest rates, print liquidity, socialize losses, privatize gains. Why? Because the moment debt contracts meaningfully, the system seizes. Pensions fail, governments default, banks collapse. So, contraction is treated as unthinkable. The result is a system that must expand forever or break. Today, Global debt exceeds 3 times global GDP. Central bank balance sheets are measured in trillions. Interest rates were pushed to zero and below. Currencies are no longer competing on strength but on who can debase more slowly. And digital money has removed even the last friction. No printing presses, no gold vaults, just keystrokes. The same pattern repeats. Crisis, intervention. Bigger promises, weaker currency. History isn't repeating exactly, but it's rhyming loudly. This system persists because it benefits specific structures. Debt-based money centralizes power, obscures accountability, transfers wealth upward over time, delays consequences beyond election cycles. Gold limited power, debt expands it, and systems tend to preserve what empowers them. 1. Money no longer represents stored value, it represents future obligation. Every dollar, euro, or yen exists because someone somewhere. 2. Crises are not failures of the system, they are requirements. Without periodic shocks, debt cannot reset or justify expansion. 3. The longer debt replaces discipline, the harsher the correction becomes. History shows this pattern ends one way, either through inflation, restructuring, or collapse. Gold didn't disappear because it failed. It disappeared because it worked too well. It told the truth. Debt tells a story. And as long as the story continues, the system survives. The real question isn't whether this system will end, it's how. Gradually. Or suddenly. If this story made you see money differently. If you felt the pattern forming long before the headlines. Subscribe. Because the real history of money isn't taught, it's disguised. And once you see the system clearly, you can't unsee it.